In the stock market, a short sell is basically when an investor sells something that they don't yet own. And so this has a couple of different purposes. The way we often think about it is it's a way that an investor can profit if stock prices actually fall in the future. And so the way this works is a short seller will go out, they'll borrow a share from someone else who already owns the shares, and they'll usually pay a small fee to the stock lender for being willing to lend these shares. And then what the short seller will do, as soon as they get the shares, they'll turn around and they'll sell them on the market. And then they basically wait and they hope that in the future the stock price falls. If the stock price falls, they'll go out, they'll buy the shares again, this time at a lower price, and they'll give them back to the person from whom they borrowed them. Right? And so they basically make a profit equal to the stock price fall. Short selling's become more common. I wouldn't say that it's something that that everyone does, but it's relatively common. And lots of different types of investors engage in short selling, and it has a lot of different purposes. So as I kind of said, it can be used to profit from a price decline. It can also be used as a hedging, as a way to hedge risk. And so you see hedge funds use this, regular investors use this, institutional investors can actually use this. So it's rare, but sometimes you can see mutual funds and those types of things engage in short selling as well. So it's a variety of different types of investors who can engage in this. I mean, the financial crisis had a lot of attention brought on short sellers. And so you opened the newspaper every day in 2008 and 2009, and you saw articles where people were complaining about short selling. And what we really wanted to see in this paper was to investigate whether or not that blame was, to some extent, correct or not, right? And I think what the paper actually found out, somewhat kind of surprisingly, was that short sellers can actually play a benefit in the market as well. And so that kind of contradicted a lot of the evidence that we saw in the crisis. And that's not to say that every instance of a short sell is good, but what we found was that on average, short sellers tend to bring a benefit to the market. Well, one of the things we found was that short sellers tend to be really good at processing publicly available information. So if a news article comes out about a firm, it usually contains a lot of complex information. And what we found is that short sellers tend to interpret, understand, kind of do more homework, and do a good job at understanding what that information meant for the value of the firm. So in that sense, they actually provide this benefit because they help prices represent the fundamental information about a firm. You know, I don't think on average they do. I don't think they do. So when you look at what we found, basically the evidence suggests that short sellers, in a sense, do their homework and get rewarded fairly for doing their homework. And again, in some sense, I think that suggests that they actually do provide this benefit to the market. So if you look back at kind of the history of short sellers, in fact, it was short sellers who were some of the first vocal critics of Enron. So they went back, they looked through the financial statements, they questioned the accounting practices, and in that sense, it was something that they profited, of course, when Enron was discovered as having accounting irregularities. But I think you could argue in some sense that that was kind of a fair way for short sellers to profit because they did their homework, they taught the market something that was useful, and then they were rewarded for doing that. In some sense, one of the big implications has to do with the regulatory implications. And so when we saw in 2008 and 2009, the SEC here in the United States, and then we saw kind of around the world, a lot of markets ended up seeing short sales bans imposed as a result of the financial crisis. And regulators at the time were arguing that that would help stabilize prices. What we saw in our paper and in other papers is that may not have actually been the best policy implication. So in some cases, short sellers actually provide a benefit to the market, and locking them out could make things worse. For some reason, short sellers are often the kind of the villains of financial markets, or at least they're portrayed that way. And I think our research suggests that's not necessarily a fair characterization. I think the source of kind of their maybe their bad reputation is just that they profit kind of when prices fall. And so to some people that kind of, it feels wrong. But if you really look deeper than that, if you kind of look at the role they're actually playing, I think what they're doing can largely be viewed as good. Because they're not making the prices fall. They're basically revealing the bad information faster, right? Those prices, to the extent that there was bad news, the short sellers didn't create the bad news. They just helped uncover it. And so people often make the mistake, I think, of associating short sellers with the bad news, when in fact they're not the source of the bad news, they just helped find it. So part of the reason we were able to do this paper and this research, and the reason people hadn't really looked at this before, is that it's only been in the last kind of 5 or 10 years that short selling data has been more easy to come by. So when you look at short sales, there's kind of 2 parts to this transaction. What the short seller does is they borrow their share from someone else and then they sell that on the market. When they sell that on the market, it looks like any other sale. Right? So it's really hard to go out and actually see who's short selling by looking at regular stock market data. But one of the things that's changed more recently is the lenders, the people who are lending their shares to short sellers, have started basically creating a database. And so you can go out and you can see which shares were borrowed. And that gives you a much better idea of who's shorting and what they're shorting. And that's data we didn't really have access to 10 or 20 years ago. I think it already is becoming an indicator. So you'll see actually there's a company called Data Explorers that gathers this data. They partner with Bloomberg and provide that data on Bloomberg terminals. And I think from my understanding, largely their client base is people who want to look at Data Explorers data and try to understand what the trends are, who's shorting what. And if you see a lot of people shorting something, then that might be a signal that you should go and do your homework about that firm. Well, I think technology in general has definitely changed how information and financial markets work together. So one of the things we've seen over the last couple of years is this amazing proliferation of technology that can help traders interpret information. And so I've talked to a number of traders. One of the technologies that's out there is people are writing algorithms that will take publicly available information, they'll process it, they'll understand what's in these articles, and they'll trade on it before a human being could ever even read the article. And so in that sense, again, the technology definitely has changed the way financial markets incorporate information. We've talked to a number of real short sellers. We've talked to hedge funds. We've talked to pension plans. We've also talked to regulators. We've talked to the Federal Reserve. We talked to the SEC. And in general, I think market practitioners, the hedge funds, the investors, I think are largely not surprised. I mean, a lot of them do believe that short sellers play a beneficial role in markets. It was kind of when you talk to regulators, that's where I think there's maybe, in some sense, our research may have provided some new information. So the SEC has a lot of different things to say. I mean, it's obviously a complicated business in terms of providing these regulations. But I think they've been receptive to all sorts of research about the rules of short sellers. They're generally interested in hearing what are the benefits, what are the costs, if any. And I think the idea is that hopefully that'll help them make better informed decisions in the future. Well, I think there are a couple different takeaways from the research in general. One of the things that we saw was in the crisis in 2008 and 2009, there were a lot of people who were complaining that short sellers were harming financial markets. And so one of the things the paper found was that short sellers can actually provide a benefit to financial markets. And in particular, we found that short sellers can provide this benefit by going out, doing their homework, gathering public information, interpreting that public information, and helping prices reflect the fundamental value of a firm. And in that sense, it's a benefit to markets. I think there's definitely more research that needs to be done on short sellers. When we kind of think about policy implications, when we think about how rapidly financial markets are changing, I think it's really important that we understand what the role is played by short sellers. Especially since they're kind of often the first person who's blamed in a crisis. And so when we have some evidence that suggests they can play a beneficial role, I think we need to kind of do more and understand what are all the implications of short sellers.